All right, thank you everybody. We'll start the webinar now. Before we start off the webinar, a disclaimer that everything that is being shared in this session is for educational purposes and is of the speaker's own opinion. It does not constitute any form of trading or investment advice. At any point during the session, if you'd like to ask any questions, you can actually submit your question in the Q&A box under the menu in Zoom. We have also allowed questions to be upvoted, so you can look at those questions and upvote these questions if you like to know the answers to them too. So today, without further ado, it's actually the third webinar in collaboration with the SGX on SG Market series, where we will be actually looking into sharing insights on trading into SGX stocks. So the title for tonight's session is S-REITs Outlook H2 2025. Okay, before we start, I would actually like to share about our ongoing lucky draw campaign that we are currently running with SGX. So let me just share the screen itself. Okay. So if you know about our SGX lucky draw campaign that has been ongoing since the start of June. So next month will actually be our grand draw. So for today is actually the draw for the August, which will happen after the end of the webinar itself. So this draw itself started in 1st June and will end on this month itself. And as long as you trade in SGX, whether is it a buy or a sell of minimum $5,000 value during this campaign period, you'll be actually entitled to one entry chance for each trade. Okay, so let's say if you invested or you traded in a selected SGX listed stocks and counters, right? You'll be entitled to two entry chances. So to see what selected SGX listed stocks there are, we actually have this appendix over here which you can click. So you will have like your mid caps and all these stocks and counters that are eligible for 2 entry tickets itself. So today is 11th September. So this is actually the August draw. So all the accumulated draw entry tickets during the August will actually be drawn in this draw itself. All right, and for today's prizes is actually we have quite a good price today. So we have the price over here, which is like Apple MacBook, and then we have like an LG TV, Apple Watch, and then we have like $100 fair price vouchers and also $50 cash credits for consolation, which will be credited into your trust account for you to do the trading as well. So next month we have our grand draw, which is happening in SGX. Okay, so we have like air tickets, cruise tickets, hotel stays as well. So this is actually our grand draw price itself. Okay, so without further ado, I would like to pass the time over to Billy, our moderator for today, to share more with you. Billy, please.
Yeah, very good evening, Evan. Thank you for joining us. I hope you guys had your dinner. I have not had mine. Anyway, I'm Billy Zhou. I'm the regional head of retail research at CGS International. So today I'll be your moderator. So just to let you guys know how the flow is like. So after I've done this brief introduction, I'll pass the time to Sally. She will talk to you about the Singapore REIT outlook, provide you some of the trading opportunities that are available, as well as some latest developments before we enter the Q&A session. I think the draw will be towards the end of it. And I think staff are not entitled for the draw. Anyway, for those of you who do not know Xialin, she is our REIT analyst. So she joined us last year. So she has been covering the REIT market, I think, for about 3 to 4 years. Prior to joining us, she was with Maybank. So she's quite an experienced analyst. So we've been talking about the recovery for REIT market for quite a bit, right? I think the start of this year, we have seen some of those materialize, and we've talked about rate cuts. I think there is quite a lot of excitement on the front. So without much further ado, I'm just going to pass the time to you. Xialin, over to you. Yeah.
Okay. Hi everyone. Welcome to our retail webinar on S-REITs today. Like Billy mentioned, we are going to talk about the REIT sector. How is the sector performing now? Where is the sector trading at, and where we see value and upside? Maybe let me just share the screen. Okay. So let's start with the year-to-date share price performance. The sector index is up 9.2% to date, mainly driven by the renewed interest rate outlook. So this week, August producer inflation declined month on month. The market is now expecting a 27 pips of cuts for next week. Our in-house forecast is pricing in two Fed fund rate cuts of 25 pips each in the second half this year. So the expectation for declining interest rates and also the falling SORA rates have built into the share price. Stock-wise, we see REITs with falling interest rates, such as OE REIT, K-REIT, Suntech REIT, benefiting from this theme. There is also event-driven outperformance in the REIT space. For example, Fraser's Hospitality Trust is privatized today. First REIT is conducting a strategic review. So we can see that reflected in their share price here as well. So aside from what we have mentioned, new developments in the sector include listing of NTT Data Center REIT in July, the proposed strategic review of Boosted Singapore, news flows on potential REIT listings by Link REIT as well as IOI properties. One thing we would like to highlight is that the accommodation service provider, Centurion, is planning to launch their REIT prospectus today after their EGM yesterday. This new REIT offers exposure to a relatively niche asset class, including purpose-built workers' accommodation in Singapore and purpose-built student accommodation in UK and Australia. Moving on to the REIT sector, this year S-REITs space has been active with acquisitions and divestments. We see hospitality names Class FEHT acquiring in Japan at the beginning of the year, followed by data center transactions by DC REIT, Stonewick, European REIT, and CLAR. Also, FCT, CICT, and Elite made their much anticipated acquisitions from their respective pipeline. FCT acquired North Point City South Wing. CICT acquired the remaining stake in Capital Spring, and Elite bought 3 government tenanted buildings in the UK. In terms of divestments, we see industrial REITs segment is much more active than the other segments. But we would say these sales are business as usual, part of their active capital recycling of smaller industrial assets. We could see this reflected by the sale price here as well. I think something to highlight here is really the Gem Office divestment by L-REIT, which was much anticipated by the market and bodes well for L-REIT as it strengthens its capital structure. Moving on to valuation. At the current share price, the S-REIT sector is trading at an average yield of 5.33%, representing a 350 bips spread over the Singapore 10-year bond yield. We could also see PB ratio has gone up to 0.95 times. On the fundamentals, S-REITs have generally been able to maintain a stable and healthy debt to asset ratio, averaging 40.2% as at end first half 25, and 75% of total debt are on fixed debt. Across the sector, we could see SESA REIT has the lowest gearing at sub 30%, and Stonewick European REIT has the highest gearing in the region of between 40 to 45%. In terms of refinancing outlooks, sector-wise, there is not more than 20% of total debt due to be refinanced over FY25 and FY26. Like what we have mentioned earlier, declining interest cost is a key re-rating catalyst for the sector this year. Interest rates in Singapore have been declining since second half of last year. So putting things into perspective, 3-month SORA fell from 3.5 in third quarter 24 to a low of 1.5% in September 25. At the same time, the Singapore 10-year bond yield had also pulled back to 1.84% in September 25. And we have positive spread between, if you can see here, we have positive spread between 10-year and 2-year bond yields, meaning from a inverted yield curve going back to a normal yield curve. Our economist is expecting 2 Fed fund rate cuts of 25 bips each in second half this year, and a further 2 rounds of 25 bips cuts in FY26. Excuse me. So as such, we think a declining interest rate trend will likely be supportive of S-REIT DPU growth due to lower interest expense as well as beneficial to equity and asset valuations. So moving on to the fundamentals of the sector, S-REITs reported their first half results in July and August. I think supporting our thesis above, we do see faster than projected DPU growth recovery from a quicker pace of decline in average debt costs. For example, those REITs with exposure to Sing dollar debt, such as FEHT, FCT, OUE REIT, CICT, K-REIT, and Suntec, they are benefiting from a falling Sing dollar interest rates. And in general, operating metrics are still robust and healthy, such as high and stable portfolio occupancy and positive rent reversions. Of course, we are also mindful of a few headwinds, such as refinancing of longer dated borrowings and swaps at current price, forex headwinds, as well as the ongoing tariff situation as an overhang. Maybe just quickly run through first half results by sector. We could go into details during Q&A later. So for industrial REITs, we see mid to high single digit reversions, incremental contribution from new assets, while tenants watch out for tariff outcomes. For excuse me, for commercial and office REIT, we still see high occupancy and robust reversions, especially at the Singapore portfolio, due to limited supply of office and prime retail assets. Sorry. Hospitality segment has fallen out of favor by the market this year. RevPAR at Singapore assets are down year on year, partly due to the normalization of travel demand, pent-up supply at certain locations from last year. We remain very selective in this segment. Moving on to overseas REITs and healthcare REITs. This segment is exposed to forex headwinds, but operational side, they are still stable. Just to touch on the Mapletree REITs that have reported first quarter results. Overhangs are still coming from their overseas assets in general, but we are seeing them doing active divestments this year. L-REIT and Star Hill Global REIT, they have both reported full year numbers we think for S-REIT, the biggest positive news is still the GEM office divestment. And for Star Hill Global REIT, it's also business as usual with divestments of some strata office units at Wisma. Then moving on to Fraser's REITs. Good operational metrics. Cathay ceased operation at two of SCT malls. Its rental areas have already been provided for. FLT has divested one of its Australian assets and will lower its gearing by 1.5%. Okay, so zooming out back to the sector, we maintain our overweight call on S-REIT sector and prefer industrial, retail, office, and hospitality in the order of preference. Our top picks are CICT, CLAR, and S-REIT. We like we like CLAR for its robust fundamentals. Portfolio reversions was high at 9.5%. We expect positive contributions to DPU from new assets and its active capital recycling this year. We expect we like CICT for its exposure to the resilient suburban retail segment and its robust balance sheet. Its rental reversion for retail and office are at 7.7% and 4.8% respectively. Acquisition of the remaining 55% stake in Capital Spring in August is DPU accretive. We also like S-REIT as we believe the recent divestment of GEM Office will lower gearing and strengthen its balance sheet, which will enable the company to tap into potential growth opportunities. Okay. Last but not least, we want to highlight some trading ideas. So like we have mentioned earlier, we talk about how share price have re-rated on the interest rate outlooks year to date. Let's recall 12 months ago, looking at this column. So 12 months ago in third quarter last year, the hopes for rate cuts were also high. So technically, share price from a year ago were priced on the previous round of rate cuts outlook. But we all know that the hopes last year eventually didn't materialize and led to the sector pullback at year end last year. So for us to look at how much the rate cuts have been priced into this share price, let's compare the share price from a year ago, this column, as well as the share price movement year to date. We can see there are three groups of stocks. So the first group is up here, where they have performed well year to date and are already above the share price from a year ago. So you'll see the positive number here. What this means is that this group is not cheap from the perspective of trading rate cuts. The second group is in the middle, where they have also performed well year to date, but they are still trading within 5% above or below the share price from 1 year ago. So what this means is that this group may not be as cheap, but as rate cuts materialize this round, they may still have upside. And these are the likes of your Impact, S-REIT, S-REIT, FCT, CLAR, and CLAS. So quality names here. The third group is the real laggards. Their share price are still quite below where they were from a year ago. So from the perspective of trading rate cuts, this group may still be cheap. These are the likes of MLP Mint, hospitality names such as FEHT, CD REIT, as well as FLCT and Manulife US REIT. If we sift through the list with their fundamentals, we think there are trading opportunities with Mint, MLT, and FLCT. And also from the second group up here, maybe L-REIT, E-REIT, Impact, CLAR, and FCT. Okay, so moving on to the last slide of our presentation. This is a sector overview. You could refer to the dividend yields on the right side of the table. And with this, we have come to the end of our presentation. I will pass the time back to Billy.
Hello, thank you. Thank you, Jillian, for the presentation. All right, I think we have quite a few questions already on the Q&A box, so maybe let's just get the ball rolling. All right, I think the first question is basically on the interest rate in Singapore. I think if you look at, I think just now you showed the chart just now that the SORA has already dropped from 3.5% to 1.5%. And so the question is basically how much of this tailwind has been reflected in the current rate prices? I think we've seen the share price for REITs basically, and what's the lag effect on the DPUs? Do you want to comment on that?
Yeah, okay. So yeah, like the question has pointed out. So I think since last year, second half of last year, SORA has been coming down, and we, in terms of how much of the lower cost of debt have been built into the share price, we also try to answer the question by looking at the share price here. But I think maybe just back to the fundamentals, how we forecast and how the REITs actually arrive at their DPU. I think lower interest because falling interest rate or cost of debt is an ongoing process as the REITs refinance their borrowings when it expires. So I would say yes, some of the REITs have already been benefiting from lower cost of debt because they refinance their current borrowings at the first half of this year, or maybe they have a larger portion of floating borrowings. That's why in in the first half results, you start to see some REITs such as OUE REIT, Suntec, they have enjoyed interest expense savings. But going forward, if you look at the cost of debt, let's say first quarter of this year and second quarter of this year, you can see it's a downward trend because refinancing is an ongoing process, like we mentioned. And also, if you look at these two columns, our projected debt cost at year end, you can see it will well extend into FY26. So these are the so we would say the lower falling SORA as well as falling interest rate across the world will bode well for REITs when they do refinance over the years because uh, maybe, yeah, like where we can see the debt maturity profile for the REIT sector. I think the refinancing for FY25 is only 5%. So as rates move across this chart, going into FY26 and FY27, they will benefit more and see more interest expense savings, and that will help REITs to arrive at a better bottom line and DPU.
Okay, Jillian, just want to extend on the questions a bit. I think just on your table that you showed before the projection on the lower interest cost, just wondering among the list, which are the REITs that benefit the most from the decline in the interest rate cost? Do you know?
Okay. Okay. So I think one way to look at this is maybe comparing against first quarter this year and second quarter this year in the past two quarters. You could see I would like to highlight maybe okay OUE REIT, it has came down from December last year. So although you don't see it here, but they have been one of the biggest beneficiary, and you could also see some tech across the 2 quarters. It has been a downward trend, and maybe FCT 20 bips in second quarter alone, and same goes for NPAC. So I think if you look at the share price performance year to date, I think the market has been very efficient in spotting all the rate cuts beneficiaries.
Okay. And just going back to the question, I think the talking about, since you show the year-to-date performance, I think we've seen the price, the REIT index are up by about 9.2%. But and valuation is at about 0.95 times of the book value. Do you see more upside from here, or has the rally priced in most of the recent recovery?
I would say interest expense savings will continue to flow in as REITs refinance their current borrowings, because for example, some of the borrowings that REITs currently have are from the period between FY23 and FY24, where the interest costs were quite high. So as they refinance, you will start to see that slowly building into the bottom line. So that will help with the DPU growth. And in terms of whether it has already been in the price, I think like we have mentioned here, so if you look at maybe above this line, above impact, so these are the REITs that are already priced at the same level from 12 months ago, where the previous round of rate cuts outlook was there, and like there was this big rally in across rate sector. So I think if you are just looking at the share price, yes, some of it are already back to the previous high, but I would like to remind the audience that the previous round of rate cuts didn't really materialize. So I think the market didn't fully price in the DPU growth from interest expense savings. And
Okay.
also across, because I think like we have mentioned here, this year as well, I think in the past few years and this year especially, we are seeing a lot more acquisitions and divestments. So the growth in DPU will not only be from interest savings, but also from contributions from new assets acquired. So I think that is what have changed compared to last year. So I think the audience should remind the 2 points. The first is interest expense savings, and the second is incremental contributions from new assets.
Okay. Jelly, just want to ask you, I think this is on institutional funds. How's the interest there on the REITs? Based on the comment from the Q&A, they say that the outflow from institutional funds have been significant in the past few years, and apparently S-REITs are only taken by retail investors. Is that the case? Based on your conversation with them, if that's the case, why so?
Okay. Maybe just look at the monthly REIT fund flows by SGX. So I think the audience is right in pointing out insti fund outflows in the past few years. But I would say in recent months there are growing interest because there is a significant change of expectation by the market. So I would say the rotation back to REITs, it's definitely starting to happen. So that is one observation. And the second observation I would like to share with the audience is that maybe just to going back to these slides. So if we look at 3-month SORA rate, it has started to climb up sharply at the beginning of 2022, and that kind of overlaps or that corresponds to where Fed rates have started to climb. But um, in terms of where Fed fund rates are today and where the SORA rates are today, we have seen a little bit of divergence in the two benchmark rates. And some of the insti funds, if they are just benchmarking S-REITs and the yield spread based on Fed funds, then they would not have come back into S-REITs as fast. So while SORA is actually coming down. So the point is that after Fed funds actually come down and more goes more in line with SORA, some of the insti funds that are based on Fed funds will come back to S-REITs as well. So that's just a personal observation on that front.
Okay, thank you, Tilly. I think there's a question on the US office REITs. Do you have any comments on that?
Okay. Sorry, behind. So I think there are three listed US REITs, US office REITs in Singapore, pardon me. So there are Manulife US REITs, Corey, Keppel Pacific Oak, and also Prime US REITs. We cover Manulife US REIT here at CGSI. If we look at the share price both year to date as well as 12 months in the trailing 12 months, we see that underperformance has continued, if not deepened. This is partly because fundamental wise, US office market is not definitely not back to its prime days. So for example, if we compare US office rates against Singapore office rates, the reversions and occupancies are definitely not there to support a strong turnaround. So that is on the fundamentals. And also, I think our audience probably is aware of the gearing issue by the US office REITs. So because of the fundamentals at current stage, the valuations and gearings are also not back to a very healthy or maybe robust stage. That's why I think the turnaround will probably take some time as well. For Manulife US REIT specifically, they are still going through asset recycling and strategic repositioning. So I think until the management is fully executing that strategy, we probably will see this underperformance to continue. Yeah.
Okay. Sorry, Jolene. Just to add on to it. So what sort of indication are you looking at to be more convinced that the turnaround is starting to materialize?
Okay, so I think first of all, definitely US office market fundamentals. So in terms of your occupancy and reversions, are they fully back to the pre-COVID levels? So that's one. And then second, it's capital management, it's gearing and interest coverage ratio, whether they are back to a healthy or maybe like even back to the average S-REITs metrics. So that's the second metric that we would be looking for.
Okay. Right. I think I'm just gonna move on to the next question. I think it's talking about what subsector within the REIT universe that you think investors would be best for the investors to go in now. It's probably
Okay.
data centers or I don't know.
Okay, I think maybe let me just quickly look at this. So our in-house preference, order of preference is industrial, retail, office, and hospitality. Uh, so these four segments, maybe just to touch a bit on industrial segment, you will see you can see the fundamentals are still very robust. Uh, CLAR is one of our top picks here. You see 8% portfolio reversions in second quarter for a REIT of CLAR size. And also CLAR has executed a few new acquisitions, and it will contribute to their revenue in the second half. Um, and also just across the segment, I think we are noticing that the the reversions are generally quite strong. Um, a lot of active capital recycling going on. So if we look across here, um, you see that CLAR E-REIT has always been executing capital recycling divestments. Um, KDC REIT and Stonewick are also considered part of the industrial segment. KDC REIT, I believe our audience are quite familiar with this name. Phenomenal rental reversion of 51% in first half, um, supported by a very strong Singapore portfolio. Healthy gearing at 30% at end of first half. So I think across the sector, it looks very it's it has got good fundamentals and also uh growth prospect. And maybe here if you look at Mint and MLT, although fundamental wise overseas assets are a little bit of overhang, um they have got green shoots as well. So I think for Mint, you see higher contributions from Osaka data center, and also interest cost guidance have been it is quite it's relatively low at 3%, 3 to 3.1%. Um, and like other industrial REITs, they have been very active in capital recycling front. And also maybe just like we have highlighted here, they are one of the laggards where you can see some trading opportunities. And then our second in the order of preference, we also like let me see, we also like retail um retail segment as well. I think these are the familiar names that we see. But in terms of share price, I think they have done very well year to date. But again, Singapore portfolio has been very stable, very robust, delivering very good reversions. And you also see some of the retail names are giving you interest expense savings. So yeah, so I think that is so these are the segments that we like and prefer. Hospitality, we are quite selective here because I think the oversupply from last year is not fully absorbed yet, coupled with a slowdown in travel demand. So I think we are quite selective here. We are within this sector, we prefer class. Yeah. So that's
Okay.
our top picks.
Okay, thank you, Celine. I just you flagged PICT, Claire, and Elvid as your top picks earlier, right?
Mm-hmm.
Can you break down what sets them apart in this cycle, especially against some of the peers, some of the advantages that you think they have, and why that you like them more than the rest?
Okay. Maybe let's start with CLAR. So CLAR, like we have mentioned just now, we think among the S-REIT industrial segment, CLAR has a very good rental reversion, diversified portfolio, and also also as one of the largest industrial REIT. It could benefit. It could be um one of the first few REITs to benefit when the rate cuts outlook materialize. Um, and also you could see growth from its new acquisitions. So this is CLAR. CICT it also tick all the boxes above. It has contributions from new assets. The first half was from Ion acquisition, and as Capital Spring acquisition comes in, we would expect that to contribute to its DPU in second half as well as FY26. And also, I think CICT has always being a proxy to Singapore retail and office because it is 95% Singapore centric within its portfolio. So I think a lot investors actually value that attribute. And also fundamental wise, strong reversions, good occupancy, and maybe moving on to L-REIT. Um, L-REIT, like we have mentioned, Gem Office divestment has been quite anticipated by the market. So the execution on the divestment is actually a positive. It's a big positive for them, especially if the management pares down debt with the proceeds. Its capital structure can be strengthened quite significantly. So this is the catalyst is quite event driven. And aside from the Gem Office and its capital management, its Singapore assets are doing quite well. Rental reversions are double digit at 10% for FY25. So I think these three names have ticked all our boxes.
Okay. Jillian, I think the last question is on Forex, so basically on the impact of the Forex, especially for REITs that have a high contribution from assets in US, China, and Europe. Do you have any comments on that?
Okay, yeah, I think Forex is definitely something to watch out for if the REIT has assets that are based in overseas markets. We see that we actually see the impacts from Forex for the overseas REITs as well as REITs with overseas exposure such as Mint and MLP. Um, I think something to watch out for is definitely uh like stronger Sing dollar against foreign currency when the REITs need to bring back the distributable income back to Singapore. You will see the impacts by lowering distributable income. So that is definitely something that you need to watch out for. But we would also like to highlight that some of the REITs uh, actually most of the REITs will hedge their overseas source income. So I think investors should remain selective, know the income hedging policy by specific REITs, and just watch out for this part.
Okay. And do you have any comments on Mapletree Pan Asia Commercial Trust?
Okay. Impact.
Yeah.
Um, I think impact. Um, it has gone through a phase of uh, it has gone through headwinds from its assets in North Asia, uh, including China, Hong Kong, Korea, and Japan. So in the past few years, it has been penalized by a certain extent because of its overseas portfolio. But this year we see it coming back strongly, partly because things are getting more stabilized in China and Hong Kong, and partly because I think the interest cost savings um, are really helping investors to rebuild that confidence. And also this year, MPAC has divested two office buildings in Japan. Although it's not very significant for its portfolio on a portfolio level, but it could lower its gearing um, if the assuming the REIT is going to pare down the debt. So I think things are definitely getting better for Impact. So I think it has already been kind of like reflected in its share price as well. Yeah.
Okay, thank you, Celine. I think overall we are quite positive and optimistic on the S-REIT as a whole. But I just want to
Yeah.
ask you to be the last question. Basically, what are the key risks that you're looking at, and basically what keeps you awake at night in terms of things doesn't shut out the way that you want it to be.
Okay. Yeah. I mean, so we have talked a lot about interest rate cuts, but um I think one thing that we would like to remind investors is that be be selective in this in trading into interest rate cuts, because um if you look at each rate and its debt maturity, some of them are refinancing their borrowings from let's say FY21 or FY20 2020, where the rates are actually even lower. So if that's the case, then maybe you will actually you probably will not see the interest expense savings to benefit their DPU that much. So I think investors should stay selective. Forex headwinds, we have talked about it a little bit. So I mean it has been in the past few years, Sing dollars have been strengthening. So you will see this eroding in impacts from forex in certain rates if the hedging policy wasn't enough to offset the forex headwinds. So I think the message we are trying to send across here is remain selective um when you buy into REITs.
Okay, thank you, Celine. Unfortunately, due to the time that we have, we will not be taking any more questions because I want to leave some time for the draw. I heard from Pei just now some people are gonna get a MacBook tonight. So, all right, Pei, I'm gonna pass the time to you for the draw.
Okay, thank you, Billy and Jialing, for the presentation.
Thank you, Celine.
So now we'll proceed with the draw for August. So this draw is actually the cumulative entry tickets for the whole month of August. So without further ado, let me share my screen on the wheel. All right. Okay, so we'll now go for the first 10 consolation prizes, which is the $50 cash credits. So these cash credits will actually be credited into your trust account, I mean your account with us, and then you can withdraw it or you can use it for your trading purposes. So let's start the spin now. So the first winner for the $50 cash credit Okay, so we will email you. You do not have to do anything about it, and you'll be credited in. All right. Okay, the second winner for the $50 credit. All right. Then we have the third one. Okay. The fourth winner. Okay. The fifth winner. And then we have the sixth winner. Okay. Have the seventh winner over here. Okay. The eighth. The ninth winner. And the last winner for the $50 cash credits. All right, so now we move on to the $500 NTUC Fair Price vouchers winners. So the first $100 Fair Price voucher winner goes to. Okay. We will write you an email and inform you to collect the Fair Price voucher, and then you can let us know when you will want to come down to collect it. So we'll communicate with you via email. All right. Okay. Second Fair Price voucher winner. Okay, move on to the third winner for the Fair Price voucher. The fourth winner. And the fifth winner. Okay, so this is the last winner for the NTUC Fair Price voucher. All right, so now we move on to our top three. So the top will be drawing the third prize. Okay, so the third prize is actually AirPods. All right, so let's go. All right, congratulations. So we will inform you to collect your prize as well. Okay, for the second prize, it's actually a LG monitor. So it's a curved monitor. So this is for the second prize. All right. All right. Now we have the top prize, which is the MacBook Air. So this is the first prize. Let's go. All right. Congratulations to all the winners. We will email to you and let you know how to collect your prizes and everything. If there's any questions or any feedbacks, you can always email in to us. All right. Thank you everybody for your time tonight. Thank you. Goodbye.